Welcome to This Explainer. Today, we're diving straight into the $39 trillion question. Literally, we're talking about debt, interest, and the economic pillars holding the whole thing up. It's a massive financial paradox, and we're going to unpack exactly how this colossal liability weighs against the structural assets keeping the global system spinning.
$39 trillion. Look, I know you follow the markets, so you already know the number is big, but let's put that scale into perspective for a second. If you spent $1 million every single day since the birth of Jesus, you wouldn't even be close to spending $1 trillion. So yeah, hearing that the US carries nearly $39 trillion in national debt, it's pretty wild. It definitely triggers a mix of shock and anxiety for just about everyone.
Which naturally leads us to ask, how on earth can a country owe that much money? It's a completely fair question. Today, we're cutting through the panic to structure the facts. We'll look at the very real risks, absolutely, but also the foundational strengths of the U.S. economy that allow this to even happen in the first place.
To do that efficiently, here's our roadmap for this explainer. First, the macro balance sheet. 2, the interest rate threat. 3, the 6 pillars of resilience. 4, crypto versus the dollar. And finally, 5, growth versus debt. Okay, let's dive right into this.
Section 1, the macro balance sheet. Now, to really get the mechanics of this national debt, it helps to kind of mentally shrink the complex U.S. economy down and treat it exactly like a giant household budget for a minute.
Check out the current numbers. The U.S. generates an absolutely massive GDP, roughly $31 trillion. But the government only brings in about $5 trillion a year in revenue, while it's spending about $7 trillion. Think of it like a household earning $5 but spending $7. Obviously, there's a shortfall. We're looking at an annual deficit of around $2 trillion. So to cover that difference, the government has to borrow. And when you do that year after year after year, well, that borrowing stacks up into the $39 trillion national debt we see today.
So, how do you actually go about borrowing a couple $trillion every single year? You sell Treasury bonds. Basically, a Treasury bond is just a government promise to investors saying, hey, give us money today and we'll pay you back later with interest. The government sells these bonds to all sorts of buyers, pension funds, banks, foreign governments. It's the core mechanism of financing these annual deficits. Moving on to Section 2, the interest rate threat. Now that we've got the borrowing mechanics down, we really need to look at the danger lurking behind those borrowed trillions. And honestly, it all boils down to the cost of borrowing. Here's where the math can get downright scary. When you owe $39 trillion, having an average interest rate around 3% keeps things, somewhat manageable, costing about $1 trillion a year in interest. But as we know, that rate is definitely not guaranteed. Just look back at the 1980s when inflation pushed rates into the double digits, or even the recent post-pandemic rate hikes. If lenders start getting nervous and demand a 6% return instead of 3%, your interest expenses literally double. Suddenly, a huge chunk of tax revenue just vanishes into paying interest. And that right there is exactly why economists lose sleep over rising interest rates. If you're eating up a massive slice of that $5 trillion in federal revenue just to pay bondholders, there's obviously way less money available for everyday public needs. We're talking about crucial stuff here: roads, national defense, cutting-edge medical research, education, healthcare. Instead of funding those things, your tax dollars are just servicing past debt. That is the real, everyday threat we're facing here. So, Section 3, 6 pillars of resilience. Hearing about all those at-risk services naturally makes you wonder, wait, is America actually going bankrupt under all these rising costs? Well, no, not necessarily. To see if the country can out-earn this massive interest burden, we've got to flip over to the asset side of the balance sheet. Let's look at the 6 pillars of resilience keeping the whole thing afloat. Pillar 1 is just the sheer scale of American productivity. The U.S. is a $30 trillion economic engine. We're talking massive value being pumped out in software, semiconductors, pharmaceuticals, aerospace, you name it. This giant churning machine generates the sheer volume of tax revenue that gives global lenders unwavering confidence that, yeah, they will actually get paid back. Then we have Pillar 2, the dollar and global trade. Look, the U.S. dollar is the world's primary reserve currency. For decades, the petrodollar framework meant global oil and international trade were largely conducted in dollars, creating this constant massive demand. And even though we're seeing some global shifts right now, with certain nations trying to hold different foreign reserves or trade in local currencies, the dollar remains completely dominant. Its unmatched liquidity and global trust give the U.S. incredible financial leverage. Pillar 3 is the Treasury market itself. It is the largest bond market on Earth. And there's this fascinating, almost ironic paradox here. When there's a global crisis and everyone panics, Investors don't run away from U.S. debt, they actually run toward it. Because of its unmatched stability, U.S. debt acts as the ultimate global safe haven for billions of dollars during a storm.
Pillar 4 builds our long-term advantage: technology and innovation. The U.S. is home to the absolute giants: Apple, Microsoft, NVIDIA, Google, Amazon. It leads the world in AI, biotechnology, and quantum computing. And this is absolutely crucial, because innovation drives productivity, and productivity drives economic growth. At the end of the day, it's that raw, forward-looking growth that actually allows the country to carry such massive debt. Finally, we combine pillars 5 and 6, energy production and financial markets. The U.S. is a top global producer of oil and natural gas, which vastly reduces energy dependence. When you pair that physical security with the deep capital markets, independent courts, and strong property rights of Pillar 6, you get incredible economic security. Global investors simply trust the U.S. system. And honestly, that institutional trust is arguably the most valuable asset any country can possess.
All right, Section 4, Crypto versus the dollar. Given how fast the financial landscape is evolving, it's pretty much inevitable that alternative assets enter the chat here.
Recently, we've heard political figures, including President Trump, discussing making the U.S. more supportive of cryptocurrencies, with some even suggesting Bitcoin could become a strategic reserve asset. But looking strictly and neutrally at the current data, the entire crypto market is still just a fraction of the size of the Treasury market. While digital assets are definitely attracting investment and blockchain tech is improving systems, crypto currently lacks the massive scale, liquidity, and global stability you'd need to actually replace traditional Treasury bonds. So right now, it acts as a complementary asset, not a replacement.
Which brings us to our final section, Section 5, Growth versus Debt. We've laid out the debt, we've looked at the interest threats, and we've weighed the assets. Now we need to address the ultimate doomsday scenario everyone constantly debates. What actually happens if everyone suddenly sells off their Treasury bonds?
Well, if a mass sell-off happened, sure, bond prices would plummet, interest rates would skyrocket, and growth would completely halt. But the crucial point is this: for a true crisis of that magnitude to occur, global investors would need to simultaneously lose confidence in 4 massive pillars at exactly the same time. They'd have to lose trust in the dollar, the U.S. economy, American institutions, and Treasury bonds, all at once. And today, there simply is no alternative market on Earth that offers that same combination of size and stability.
So yes, the debt is a very real challenge. And rising interest costs mean future governments are facing some incredibly difficult choices regarding those public services we talked about. But remember, debt alone doesn't determine a nation's destiny. The ultimate question for investors, policymakers, and really all of us is this: can innovation, productivity, and economic growth continue to outpace the growth of debt? Can those 6 pillars continue to outrun a $39 trillion liability? That, my friends, is the defining economic question of our time. Thanks for joining me for this explainer, and keep questioning the numbers.